What's up, everybody? It's your name here, and welcome back to the channel. Now, I'm all about that passive income. Real estate, index funds, you know the drill. But so many people ask me about Forex, and for a good reason. It's the largest and most liquid market in the world, and the potential to make money is huge. But it's also incredibly risky, especially if you're just starting out. In fact, a lot of people compare Forex trading to gambling, and you know what? They're not entirely wrong. Just like in Vegas, most people who walk into Forex trading end up losing money. But here's the thing, the difference between gambling and investing is knowledge, strategy, and risk management. So if you're thinking about dipping your toes into the world of Forex trading, or if you've already started and you're feeling a little lost, this video is for you. Today, we're diving into the top 5 Forex trading mistakes to avoid in 2024. These are the mistakes that can absolutely wreck your chances of success if you're not careful. Avoid these, and you'll be way ahead of the game. Welcome to our channel. Today, we're diving into the top 5 Forex trading mistakes to avoid in 2024. Whether you're a beginner or an experienced trader, these tips will help you navigate the Forex market more effectively. All right, let's talk about over-leveraging. This is the classic rookie mistake, and honestly, it's one of the biggest reasons why so many people blow up their accounts in Forex. Look, I get it. Leverage is tempting. It's like this siren song whispering promises of insane profits in your ear. You see a 50-to-1 leverage ratio and you think, man, I could turn $1,000 into $50,000 overnight. And yeah, technically you. But you could also lose it all just as fast. See, leverage is a double-edged sword. It magnifies your profits, but it also magnifies your losses. Think of it like this. If you're using 50-to-1 leverage, even a tiny 2% move against you wipes out your entire account. Poof, gone. Now you might be thinking, okay, but I'm a good trader. I'm not going to let the market move against me that much. And hey, maybe you are. But the market is a wild animal, and it doesn't care how good you think you are. Things happen. Unexpected news events, economic data releases, that can cause sudden and dramatic price swings. And that's why, in my opinion, most beginners shouldn't even touch leverage. Seriously, I'm talking like zero leverage. Stick to demo accounts and learn the ropes before you even think about risking real money. Now, for those of you who are a little more experienced and you absolutely insist on using leverage, here's the rule. Never ever use more leverage than you can afford to lose. And I don't just mean money you can afford to lose. I mean money you'd be completely okay with setting on fire and never seeing again. Because in Forex, there's a very real chance that's exactly what's going to happen. Alright, so you've heard me rant about over-leveraging, but honestly, ignoring risk management is right up there with it in terms of Forex trading sins. And the crazy part is, risk management is so simple, yet so many people just completely ignore it. It's like they think it's some kind of advanced trading strategy only reserved for the pros. But trust me, risk management is the foundation upon which everything else is built. It's the difference between staying in the game for the long haul and blowing up your account in a matter of trades. So, what does good risk management actually look like? Well, it starts with understanding your risk tolerance. How much are you actually willing to lose on any given trade? Not how much to win, how much you can afford to. Once you've got that number in mind, you need to stick to it like glue. And that's where stop-loss orders come in. These are your absolute best friend in Forex trading. A stop-loss order is basically an instruction you give to your broker to automatically close your trade if the price of a currency pair hits a certain level. Think of it like an insurance policy for your trades. It limits your downside risk and prevents you from making emotional decisions when the market is moving against you. Now, I know what you're thinking, but your name, what if the price drops below my stop-loss and then goes back up? And yeah, that can happen. But you know what? It's better to lose a small amount on a trade that went against you than to hold on and risk losing way more. Remember, in Forex trading, preserving your capital is the name of the game. Alright, let's talk about another one of the deadliest sins in Forex trading, chasing the market. We've all been there. You see a currency pair skyrocketing in value, everyone's talking about it, and you're like, man, I'm missing out on all the profits. You get that fear of missing out, that FOMO, and before you know it, you're throwing money at the market, hoping to catch the tail end of the move. But here's the thing. Chasing the market is like trying to jump on a moving train. You might get lucky sometimes, but more often than not, you're going to end up getting run over. When you chase the market, you're essentially buying at the top and selling at the bottom, the exact opposite of what you want to be doing. So, how do you avoid falling into the trap of chasing the market? Well, it all comes back to having a solid trading plan and sticking to it. Don't let your emotions dictate your trades. Don't get caught up in the hype. And for the love of all that is holy, don't try to make back your losses by chasing after bad trades. Remember, patience is key in Forex trading. The market is always going to be there, and there will always be new opportunities. Don't feel like you have to be in every single trade. Wait for the right setups, the setups that align with your trading plan, and then execute your trades with discipline. Let's be real here. Forex trading is not a get-rich-quick scheme. It's not something you can just jump into blindly and expect to make millions overnight. In fact, if you're not careful, it's probably one of the fastest ways to lose your shirt in the financial markets. You wouldn't believe how many people I see diving headfirst into Forex trading without even understanding the basics. They don't know the difference between a pip and a lot. They can't read a candlestick chart, and they're relying on some random dude on YouTube to tell them what trades to make. Don't be that person. If you're serious about Forex trading, you need to be prepared to put in the work and educate yourself. Learn the ins and outs of the market. Understand how economic indicators affect currency prices. Study different trading strategies and find one that aligns with your risk tolerance and trading style. And listen, I know all this research can seem daunting, especially if you're new to trading. But trust me, the more you know, the more confident you'll be in your trading decisions. And that confidence can make all the difference. So, where do you start? Well, there are tons of great resources available online. Books, articles, courses, you name it. Just be sure to do your due diligence and make sure you're learning from reputable sources. Remember, in Forex trading, knowledge is power. The more you know, the better equipped you'll be to navigate the market and make informed trading decisions. Alright, we've arrived at the final, and perhaps the most insidious, Forex trading mistake: emotional trading. This is the one that can sneak up on even the most experienced traders and completely sabotage their results. See, the thing about Forex trading is that it's not just about charts and indicators and economic data. It's also a psychological game. A game that you play against the market, but more importantly, a game you play against yourself. You see, the market is designed to exploit your emotions, your fear, your greed, your hope, your despair. And if you let those emotions dictate your trading decisions, you're toast. Fear can make you hesitate to enter trades or exit them too early. Greed can make you hold on to winning trades for too long or take on too much risk. And hope? Well, hope can make you hold on to losing trades way longer than you should, praying for a miracle turnaround that never comes. So, how do you avoid the trap of emotional trading? Well, it all comes back to having a solid trading plan and sticking to it no matter what. Your trading plan should be your North Star, guiding your decisions even when the market is throwing everything it's got at you. And when you do find yourself getting emotional, whether it's fear, greed, or anything in between, take a step back from the charts. Go for a walk, hit the gym, do whatever you need to do to clear your head and come back to the market with a fresh perspective. Remember, in Forex trading, it's not about being right or wrong all the time. It's about making consistent, disciplined trades over the long term. And that means keeping your emotions in check. So there you have it, the top 5 Forex trading mistakes to avoid in 2024. Look, I'll be straight with you. Forex trading is not for the faint of heart. It's a challenging and often unforgiving market. But it can also be incredibly rewarding if you approach it with the right mindset and a commitment to continuous learning. Remember, the key to success in Forex trading is not about getting rich quick. It's about protecting your capital, managing your risk, and making consistent, disciplined trades over the long term. Avoid these mistakes, put in the work, and who knows? Maybe you'll be one of the few who actually make it in this crazy world of Forex trading. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and hit the notification bell for more trading tips and strategies. Happy trading!